Today we'll talk about catch-up contributions with whole life insurance policies, which is a very unknown topic. We're going to specifically answer two questions. The first is, if I miss a payment or I pay in less than what I had planned to pay into the policy 1 year, can I make up that payment later? And then second, if I have extra money, should I put that money into a new policy or into an existing policy? And we'll answer that question right now. I would always recommend putting more money into an existing policy instead of getting a new policy. And the reason why is because when you look at a whole life insurance policy, what's the worst year about it if you're focusing on the cash value? Every single time it is the first year. What's the best part about that policy? Every year after the first year. So if you have room to add more money into an existing policy, what you will find is that is always going to be in your best interest. Again, if your focus is getting the most cash value. If you're interested in another policy for more mech space or a larger death benefit, that's a different story. But if cash value is your goal, what you'll see in almost every single case is adding any extra money you have to an existing policy will yield you greater results. Now, let's answer the first question, which is, if I miss a payment or pay in less than what I would have liked to have paid, can I make up for lost time? So what we're going to look at is a specific case study. We're going to look at a guy named Joe. He wants a policy where he can fund up to $100,000 per year. The thing is, he does not want a bill for $100,000 per year. Now, Joe is going to have future windfalls, which include property sales, a future inheritance, and also bonuses from his employer. Now he's interested in whole life insurance, specifically for the cash value. And the reasons why is because he sees that it is a safe place to put money. It's liquid in the sense that he can access it anytime without any penalties. And it's tax-free if we follow IRS rules. Now with his policy setup, he again wants to be able to fund up to $100,000 per year, but he does not want a bill. So here's how we set up the policy. His target funding is $100K per year. Of that $100,000, the premium piece we minimize. So it's $10,000, meaning 10% of the desired $100K is what he is committed to. You're going to see this when we go through the illustration. Now, a little bit on the premium piece. This is specifically referred to as your base premium with a whole life insurance policy. It prioritizes life insurance first. This is the amount we're billed for, meaning we must pay it, especially when we start a policy. And it also generates the highest commission to agents and agencies. I say that just to let you know that as an agent, we are literally incentivized to sell more premium. So that's the premium piece. The second piece we have is called our PUA, which stands for Paid Up Additions Rider. Here, you'll see $90,000 going there. So PUA rider, or dollars we put here, prioritizes cash value first. It's flexible, meaning you are not obligated to pay this like you are the base premium. And it generates the lowest commission to agents and agencies when we look at different areas to put our money. Aside from the premium and PUA rider, there are other riders you could add to a policy, such as term insurance riders, waiver of premium riders, long-term care riders, and the list goes on and on. But if you look at the commissions, the highest commission will always be on the premium, and the lowest commission will always be on the paid up additions rider. Okay, let's talk about some rules here, and this will lead into answering the question, if I miss a payment, can I make up for lost time? So all insurance companies have different rules specifically around their paid up additions rider. Now, what is always important here and almost required if I want to be able to make catch-up contributions in the future is what's called a term insurance rider, specifically an OYT, which stands for 1 year term insurance. If you have a 1 year term insurance rider, what it will allow you to do is make huge PUA payments without the need to go through any medical underwriting. I'll give two examples. One is Guardian. They are extremely flexible as a life insurance company. If you have their 1 year term rider attached to a policy, you can literally log onto your online portal, could also be your mobile app, and just send money into your PUA rider. There's no limit as to the number of times you can do this over the course of the year. You can literally just drop funds in, which is sweet. The most we can illustrate as an agent is 10 times whatever your minimum premium is in PUAs per year. However, it can exceed that when I'm making catch-up contributions, which you'll see in a moment. But the big thing is if I have that 1-year term rider attached with Guardian, I can log into my portal and just throw money into PUAs. If I'm maxing it out every year, it's 10 times the base premium. If I do not have that 1-year term rider attached, then the most I can add to PUAs is typically 3x the base premium, not 10x. That's through the 10th year, and then it drops to 1 times the base premium after that. So having that 1-year term rider gives me as a policyholder a permission slip to add more money into PUAs. You'll see exactly what I mean in a moment. Another example would be Mass Mutual. The same rules apply where I can make large PUA payments without medical underwriting if I have that 1-year term rider attached. That is specifically referred to as their LISR or LISR rider, and again, that's with Mass Mutual. The difference with Mass Mutual is I can make those big PUA payments only 1 time per year without any underwriting, whereas Guardian lets me add the additional PUAs at my discretion. So those are 2 examples of insurance company rules. Next, we have our modified endowment contract or MEC rules. So why Joe is attracted to whole life insurance is because the cash value is a safe, liquid, and tax-free area to put money. The tax-free piece is really what he's interested in. Now, any life insurance policy can become classified as a modified endowment contract, and if it does, it's going to function similar to a 401k, where the cash value still grows tax deferred, but if I want to access it, I have to pay ordinary income tax only on the gains, and if I access it before I'm 59 and a half, I got to deal with a 10% penalty tax, which we don't want. Now, the good news is you can easily prevent this. How you do so is every policy has what is called a MEC limit. It's exactly what it sounds like. It's a limit that is regulated by the IRS that determines how much you can pay into your policy per year. So usually what we like to do is set the MEC limit at the maximum yearly funding. So if Joe says, I want to be able to put in up to $100,000 per year, we're going to set that MEC limit at least $100,000. What we'll do for people that want to be able to fund a policy for a long time is overinflate the MEC limit a little bit. Meaning if I want to put in 100K, I might set my MEC limit at 120,000 or something like that. Now, here's the fun part to be aware of, and this will answer the first question up top. Unused MEC space or rollover dollars. If I miss a payment, can I make up for lost time? The answer is yes, you can. So remember the old cell phone plans from AT&T, rollover minutes, how those worked? If you had 100 minutes per month, but you only used 50, what would happen to the 50 unused minutes that you didn't talk on the phone at all? They'd roll over to the next month. So now you've got 100 again, plus 50 minutes from the prior month. When it comes to the MEC rules with life insurance policies, it works very similar. So for example, if I have a policy with a $100,000 MEC limit, and I only pay in $50,000, the $50,000 I did not pay will roll over to the next year, and I can make a catch-up contribution if I want. And that's cumulative, where it keeps on rolling over time. Let's go through a quick example. Let's pretend that I have a policy with a $100,000 MEC limit. In the first year, we'll assume that I max it out. I fund up to $100,000. Okay. That means in terms of my rollover space, I have nothing because I maxed it out. So when I look at the maximum payment, it was 100K, but nothing rolled over. Now the next year, let's pretend that I only pay in $50,000. What's going to happen now? Well, when I look at my rollover MEC space, I could have paid in 100, but I only paid in 50, which means 50K is going to roll over. So now when the next year comes, my MEC limit resets at $100,000 plus the unused MEC space from the prior year that rolled over. So the maximum payment would actually be $100K plus 50. I could fund up to $150,000 this year if I wanted to. And again, it's cumulative. So that's an IRS rule. Now, in order to be able to actually make a big catch-up contribution like this without the insurance company just telling me no, or saying, well, before we accept your money, we'd like to put you through medical underwriting, which involves blood work, urine, a medical exam, height, weight, all that good stuff. We don't want any of that. So that's where we go back to that one-year term insurance rider, which makes life very convenient in that respect. Make sense? I know it's complicated. We're going to look at an example in a moment. So let's take a look here at an example. And we're going to look at one policy. It'll be a policy on Joe, who we started with here. And what we're going to look at first is his perfect plan. He comes in and says, I want to fund this policy with $100,000 per year for 10 years. That's a total of $1 million. Okay, so we're going to start with that policy. Then what we're going to look at is a life happens scenario. And what this will show is the exact same policy. So we're not setting it up any differently. In the first year, he's going to fund 100K, but then in the second year, life happens. And instead of funding 100K per year, you're going to see 25,000 per year for 8 consecutive years, years 2 through 9. And then in year 10, we're going to pretend he has one of his large windfalls or liquidity events, and he throws $700,000 into the policy without any medical underwriting, which gets a total of $1 million into the policy. Let's take a look. So first, we'll look at the actual illustrations. Here is his perfect plan. So what we've got with the perfect plan is exactly what we mentioned, the funding of 100K per year for 10 years. So as we look at this guy, what do you notice? Well, you'll see 100,000 under the annual outlay column. If I'm you though, I want to know where the money's going. Here's the underlying base premium. Remember where we talked about minimizing that to 10%? So that's what we're doing here, okay? And then we've got LISR, that's that one-year term rider, and then also AILR. LISR is actually a combination of that term rider and PUAs to make things more confusing. And then AILR stands for Additional Life Insurance Rider, which is Mass Mutual's pure PUA rider. So what we've got going on here is, again, we're funding the policy exactly as planned. 100K per year for 10 years. Here's his money column, net cash value, first year, 92.4, so just over 92%. Break even point, by the fourth year, he's paid in 400,000. He's got 399, just about 400,000. So the break even is just about year 4. This is a policy that is very cash rich. The main reason why it's breaking even that early is because he's got a 10% premium, and we literally 10x'd that in the first year. He dumped in 100 grand. That's the reason why. If we look at the MEC limit on this policy, we can scroll up a little bit. This one we did overinflate, where the MEC limit is about 125. The reason why is because we also looked at an option where he can pay into this policy with 100K per year for 30 years, which we'll go over that in another video, which will be this very similar to this case study, but that's why that MEC limit is a bit higher than where we would usually put it, because he wanted the option to fund for a long time. Anyway, what we want to look at is the exact same policy now, but with a catch-up payment. So what we'll look at first is what we just saw. This is the perfect plan, but on Excel. This will simplify things. So we've got the base premium, the PUA rider. The PUA rider does include the term insurance cost as well. But if you add those two together, his true net out-of-pocket is 100K per year for 10 years. Then you've got the total outlay, cash value, and death benefit. What is highlighted in yellow represents the first year that his cash value is equal to or greater than his total payments. That's why we have that highlighted in yellow, because what people don't like about whole life insurance is when they run a loss. So I want to see how quickly I get out of that hole, meaning no longer have a loss. Okay, let's move on to the catch-up contribution illustration. So we've got the product name up here. Let's take a look. Same product. Everything is going to be identical. Same product. Same premium up here, 10K. There's your underlying minimum premium. Same LISR and ALIR. Same first year payment with 100K going in. So he pays in 100,000 in the first year. Do you remember what his cash value was in the last example? Look at that. 92,409. It's identical. If we scroll up, you've got the exact same MEC limit up here, which is fantastic. So again, we've got the exact same policy. What's the difference? Well, this is the life happens scenario. So what we're assuming here is that he funds 100K in the first year, but then life happens immediately after that. So here we've got funding of 25K per year. So this would involve us reducing the PUA. He's got his 10K base premium. And then we've got 15K going toward PUAs. Add the two together, that's where we come up with our 25K. So we do that through year 9. And at the 10th year, here's a $700,000 deposit. That's huge. So we dump in $700,000. Look at your cash value. Gradually going up when we pay in the 25 per year, and then we get a huge jump up here. Now you'll notice it doesn't increase by quite $700,000. It's a little bit less. The reason why is there are PUA fees anytime we make PUA payments. And if we make a big one, specifically a PUA deposit that's larger than our total cash value, we'll almost always see this, where we take a loss in that initial year, but then afterwards, we see it really jump and start to accelerate if we measure the annual growth rate. Let's take a look at the two side by side. Fascinating stuff, isn't it? And we've done this with clients before too. A lot of times over the years with both Mass and Guardian. So here we go, exact same policy. Here's a breakdown of where our money is going. Here you go. The break-even point's the same. Look at that, just about year 4. And again, that's because he did max fund it in the first year. But then as we look at it over time, by the 10th year, we get the same $1 million in. So he got his same target amount into the policy, we just did it differently. The thing is, where this is extremely valuable information, I think it is at least, is because a lot of times people move forward with a whole life insurance policy that doesn't have a 1-year term rider, or it's with a company that has more strict PUA rules, and they can't do something like this. Meaning they might have the MEC space, or they could have had the MEC space to make a big catch-up contribution, but they don't. And now if they have a big windfall, they end up opening a new policy, which is okay if it's the last resort. However, if I'm going to fund a new policy with 700 grand, even if I break it up over 3 or 4 years, it's going to take 3 to 4 years to break even. Versus here, I see the majority of it show up in cash value immediately. It starts compounding. I've got a 10-year-old policy that's beyond the expenses. It's in my best interest if, again, I'm laser focused on the cash value. So it's a nice item to be aware of. Again, we like to set up almost all policies with this option where a client can make catch-up contributions. Not everyone does this, and you can take this option away by removing the term insurance rider. That sometimes does make sense depending on the client's circumstances. Now, what's the drawback to this? Well, there's drawbacks to everything, right? Here's the drawback. The example to the left, the perfect plan, he gets 100K in every single year. With the option to the right, he doesn't do that. He gets the majority, 70% of that million, into the policy by year 10. So he loses out on the compounding by getting the money in late. Now again, it's better than just getting new policies, but at the same time, it's important just to highlight this. So the first year, there's no difference because it's the exact same policy and we pay the exact same amount. But as time passes, you do see that difference. And that's just the power of compounding, where it's beneficial to be aware of this. But to conclude, if I miss payments or pay in a lower amount than I had planned, my perfect plan, can I make up for lost time? The answer is yes. It's very easy as long as I go with a company and designed the product with that company in a manner where they will allow it. The big thing to be aware of is just making sure we know the rules of the game, as I like to refer to them as, so we can make these catch-up contributions without having to go through medical underwriting, a bunch of paperwork, because that's a pain, especially if my health has changed. Now I'm not going to be able to do that. Whereas if I have this one-year term rider, I can do that. And how the insurance company allows that, just to conclude, when you make that big catch-up contribution, you're not going to see a huge increase in the death benefit because it's buying down the one-year term rider. If you'd like more information on that, I would search OYT or one-year term on our YouTube channel, and you'll see videos come up that describe exactly how that rider works. Hope you enjoyed this video. If you have any questions, thoughts, or comments, please leave them in the comments below. You can also DM me on any of our platforms. LinkedIn is one of my favorites if you'd like to connect, or you can check out our website. As always, I hope this helps. Thanks so much.